welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness. All right, well, you're back with the Don and Gino Real Estate and Finance Show this fine Saturday morning. Hopefully you're taking heed and hiding from the heat a little bit, but it's a balmy summer, just sticking around the three-digit mark there. We just had two excellent segments of the show with Bob Keller, who is just instrumental in making this city the great city that it is. And love talking politics with Bob because we do have a great city, and he's been an instrumental part of that. Gosh, I think for over 25 years. So thank you, Bob, for joining us on the show and for making this city great and continuing to make this city great along with the team of our city council that helps us be the best place to live in the Los Angeles area. So I wanted to talk about a little bit. I know that you're hearing about rising interest rates over and over again, rising interest rates, rising interest rates, rising interest rates. The media is all over rising interest rates. And rightfully so. However, unfortunately, there's a misconception to what rising interest rates mean. And I know that Don and I talk about this on the National Real Estate Cafe fairly regularly. So for the National Real Estate Cafe, if you want to get the day-to-day information on what's happening with an economic update, go to donandgino.com, go to the National Real Estate Cafe tab, and you'll find there the daily video blog that Don and I do to make sure that you're in the know. And we take all the spins out of it. We don't try to sensationalize it. We don't do anything just to get views. We just want to make sure that you get great information and you have an idea what's going on with this economy. So the rise of interest rates is actually a good thing. So let's talk about that. The Fed's job is to moderate inflation. And to moderate inflation in the definition of the Fed is to keep the Fed's preferred inflation metric at around 2%. So you'd like to see a GDP at around 3%. You'd like to see inflation at a 2%. That means you have 1% of natural growth every year. That's the Fed's job, is to try to moderate this. So that forms part of our economic checks and balances that we've had in this country for so many years. And as you've also seen, it's very painful when those checks and balances fall out of place. One example I could think of is a Fed, I think it was Volcker's Fed in the 70s, had to raise interest rates to 14% just to be able to stave off the amount of inflation that we had. So this Fed, I think, is doing a great job in being relatively aggressive. Initially when the economy wasn't doing well, they were very flexible and they kept rates almost at zero for a very long time. The reason they did that was to continue to stimulate the economy. Now we have a stimulated economy with good growth, good employment, and relatively moderate inflation. So their job now is more about moderating inflation than it is creating opportunity. The economy itself already has momentum, and therefore their now is just to make sure it doesn't get out of control. So what you'll see is they continue to raise short-term interest rates. Short-term interest rates affect home equity lines of credit, credit cards, personal lines of credit, business lines of credit, things of that nature, things that are short-term in duration. And what I mean by short-term is 10 years or less, 7 years or less, or 5 years or less. Those are all considered short-term loans. They don't have a direct impact on long-term loans, which are mortgages, 20, 30, 15-year mortgages. A little bit of an impact on 15, but the further away you move down the yield spread chart, you end up at longer mortgages are not directly affected by Fed changes. So we have now a situation happening where we are seeing the rise of the short-term interest rates and the compression of long-term interest rates, which will result in an inverse yield curve. So if you're a stock market person and you've been watching the stock market or watching any of the economic indicators, one of the things that you'll find is that an inverse yield curve is a signal for a recession. So this is not a time to panic. Recessions are not all bad. Recessions can be healthy for an economy because that's how we keep inflation under control. So I wanted to take this time to take a minute on the Don and Gino Real Estate and Finance Show and educate you on these short-term interest rates and the impact they're going to have on our economy, because we're going to continue to see them rise over the next 2 years. We're going to see probably another 4 to 6 rises in the prime interest rate by the Fed. in order to stave inflation and moderate inflation. They're going to do this at the risk of throwing the economy into a recession. So a recession is defined by 2 quarters of no growth or negative growth. That doesn't mean it has to be a crash, so there's nothing to panic about, but it's something to control growth so it doesn't give us too much inflation. I just wanted to talk about that a little bit because I know everybody's concerned about rising rates and how that's going to affect the real estate market. So the real estate market is booming. There is no doubt about it. Homes are appreciating at very high levels. Around the country, we're seeing levels between 6 and 12%. Here in LA, we're seeing a moderate, about 8% growth. And now the thing about 8% growth is 8% growth on a $500,000 property. You're talking about properties going up $40,000 a year. So it can quickly spiral out of control if we start seeing double-digit inflation. So something to watch out for is if the reduced inventory of homes continues to push appreciation higher, and now we're putting ourselves in a situation where we've got an inverse yield curve and we have a super double-digit appreciation on one of the least affordable markets in the nation, you're starting to put together a recipe for things that are complicated. The other thing, the other signal of a recession is full employment. And we do have pretty much full employment. When you have unemployment at the 4% mark, that means almost everybody that's working, almost everybody that wants to be working is working. And that's another one of the less known indicators that are going to put you into recession. So am I saying there's going to be a recession this week? No. Am I saying there's going to be a recession this year? No. Everybody that we talk to, and economists and global economists and people that are watching this trade war develop and things of that nature say, look, there should be a slowdown, a moderate slowdown in mid-2019, and we might have a legitimate recession in 2020. So what does that mean to you? That means that at that point, prices will probably change. In some industries, prices will actually rise depending on what the commodities look like, and in others, they'll fall. That also means that interest rates will probably turn the corner and start dropping again. So you'll see interest rates rise for quite some time for the next couple of years, and then you'll see interest rates dropping again. And that's how we've moderated our economy over the last 100 years. So it looks like everything is fairly healthy. We've got a great Fed. We've got a great economy. So consumer confidence is at all-time highs. Business confidence is at all-time highs. I think it's a really good time to make investments, feel comfortable, invest in your children's future, invest in real estate, even the stock market. I know a lot of people are concerned about the stock market and they're waiting for it to crash, waiting for it to crash, waiting for it to crash. I don't see it happening. I don't see a stock market crash. Do I see a correction? Sure, yeah, Netflix had a bad week. Someone's going to have bad earnings. Maybe 3 or 4 tech stocks are going to crash a little bit because we're fearful that the market's going to turn, but the fundamentals behind the market look very good. So our earnings ratios are not crazy like they were for the dot-com bust. The fundamentals for the companies show that a lot of companies are sitting on cash. Apple's sitting on a tremendous amount of cash. Not a lot of companies are over-leveraged and overburdened. So I got to tell you, I feel pretty good about the economy for the next 2 years. I hope you do too. I hope that you send us emails at donandgino@gmail.com. Tell me if I'm crazy. Tell me what you're feeling in the street. Tell me if you're confident in your job. Tell me if you're looking to buy a home and you think it's a good time to buy a home. I know it's expensive. I know the prices have gone up quickly. It's not going to get any better. We don't have enough homes being built, and we're going to be seeing a lot of pressure for builders to build, so we can't wait for the New Holland project to get going. Tesoro 2 is getting going. There are a lot of properties that are coming online, and we should see those hit in 2020. A lot of properties coming online right when the recession hits. That would be interesting. So when we come back, we'll talk a little bit with a couple of people here in the office. I'm going to drag some people in here to share what they think about our economy and how they feel about working here at Skyline Home Loans.